If your 401k statement says $800,000, how much of that is actually yours? Take a second and really think about that number. Most people assume the answer is simple. All of it. It's my account, my balance, my money. But here's the truth nobody tells you when you're 25 and just started contributing. That number on your statement is not the number you get to spend. Taxes haven't been paid on it. The market hasn't finished testing it. And inflation hasn't taken its bite yet. By the end of this video, you're going to understand the three ways your 401k balance quietly lies to you, and more importantly, what you can do about each one before it costs you in retirement instead of after. Let's start with the biggest misunderstanding. A traditional 401k balance includes money that already belongs in part to the IRS. You just haven't paid them yet. Every dollar you put into a traditional 401k went in pre-tax. That was the deal. You got a tax break today in exchange for a promise. You'll pay taxes later when you take the money out. So let's put real numbers to it. Say your statement shows $800,000. Once you retire and start pulling from it, that money gets taxed as ordinary income, layered on top of your Social Security and any other income you have. For a lot of retirees, that lands them in an effective tax bracket somewhere around 22 to 24% once you add everything together. That means a chunk of that $800,000, potentially $150,000 to $200,000 or more, was never really yours to spend. It was always earmarked for taxes. Your statement just doesn't show you that line item. And here's where it gets more complicated. Once you turn 73, the IRS requires you to start taking required minimum distributions, or RMDs, from that account, whether you need the income or not. That forced withdrawal can push you into a higher tax bracket than you were planning for, simply because the government is requiring you to take out more than you wanted to. And there's a second, quieter consequence. A large RMD can also increase your Medicare premiums 2 years later through something called IRMAA, the Income Related Monthly Adjustment Amount. In plain terms, pull out more money than expected in 1 year, and you could be paying higher Medicare Part B and Part D premiums a couple of years down the road. Your account balance never warns you that's coming. The second lie is about timing. Your balance reflects what your account is worth today. It says nothing about what it'll be worth when you actually need to start drawing from it. This is where something called sequence of returns risk comes in, and it's one of the most misunderstood risks in retirement planning. Here's the concept in plain language. It's not just your average return over time that matters. It's the order those returns happen in, especially in the 5 years before and the 5 years after you retire. Let me give you an example. Imagine two people. We'll call them retiree A and retiree B. Both retire with $800,000. Both average the same exact 6% return over a 20-year retirement. Identical numbers on paper. But retiree A hits a couple of down years right at the start of retirement. Say the market drops 15% in year one and another 10% in year two, while they're already withdrawing income to live on. Retiree B gets the mirror image, strong growth in those same early years, and the downturns come much later. Even though their average return is identical, retiree A can run out of money years before retiree B, sometimes a decade or more sooner. Why? Because withdrawing income from a shrinking account locks in losses. There's less money left to recover when the market eventually bounces back. Your statement balance assumes the market cooperates with your timeline. It doesn't have to. And that's a risk that shows up quietly, usually right when you can least afford it, the first few years after you stop working. The third lie is a little less dramatic, but it adds up over time. Your balance doesn't account for inflation or ongoing fees. Most 401k accounts carry fund fees, often between 0.5% and 1.5% a year. That might sound small, but over 20 or 30 years, fees like that can quietly take a real bite out of your growth. Then there's inflation. A dollar today doesn't buy what it used to, and it definitely won't buy the same thing 20 years from now. Think about it this way. If inflation runs around 3% a year, something that costs you a dollar today could cost you nearly $2 in 20 years. Your statement doesn't adjust for that. It just shows you a flat number, frozen in today's dollars, as if the prices are going to stay the same. They won't. None of this means fees or inflation will wreck your retirement on their own, but combined with taxes and market risk, they're one more reason the number on your statement overstates what you'll actually be able to spend. So, if the balance on your statement isn't a real number, what should you be actually looking at? Here's a shift I want you to make. Stop asking, how big is my balance? And start asking, how much guaranteed spendable income can this create for me after taxes? That's the number that actually determines your lifestyle in retirement. There are a few categories of tools that can help close this gap. One option is converting a portion of that balance into a fixed index annuity, or FIA. A properly structured FIA can provide a guaranteed income stream that isn't exposed to market downturns. So a bad sequence of returns in year 1 or 2 of retirement doesn't put your income at risk the way a fully market exposed account can. Another piece of the puzzle is proactive tax planning. Things like strategic Roth conversions or carefully timed withdrawals designed to manage your tax bracket and stay under key IRMAA thresholds instead of letting RMDs force your hand later. I want to be clear. These are categories of solutions, not a one-size-fits-all answer. The right combination depends on your specific accounts, your age, your income sources, and your goals. But the point is this: once you know your real after-tax risk-adjusted number, you can actually plan around it instead of being surprised by it later. So let's bring all this together. Your 401k balance can lie to you in 3 ways. Taxes take a bite you haven't accounted for. Market risk can hit at the worst possible time. And inflation and fees quietly shrink your purchasing power over the years. None of that shows up on your statement, but all of it shows up in your retirement. If anything I've shared today resonated with you, get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. If you found this video helpful, please give it a thumbs up. It helps more people find this channel and get access to this kind of straightforward retirement education. And if you're not subscribed yet, hit that subscribe button and the bell notification so you never miss a video. I'm Shonda Prescott, and this is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.